Get your free copy of the complete tutorial at www.teachucomp.com/free. Dividends are distributions by corporations to its stockholders. Dividends can take the form of cash, property, promissory notes, or stock. In financial statements, dividends are generally reported quarterly as a dollar amount per share of stock. A cash dividend is a distribution of cash to stockholders that is proportional to ownership. In order for a corporation to have enough funds to pay out dividends, it must have retained earnings, adequate cash, and declared dividends for the period. It's also important to understand retained earnings in a business. Retained earnings is the net income retained in a corporation after paying off its debts. The retained earnings statement shows the amounts and causes of changes in retained earnings during the accounting period. The beginning retained earnings amount appears on the first line of the statement. Then the company adds net income and deducts dividends to determine the retained earnings at the end of the period. These statements are valuable because financial statement users can evaluate dividend payment practices. It's also important for potential new stockholders to understand dividend payment practices. If a company historically pays out a larger dividend, it is more likely for them to gain stockholders in the future. Like what you see? Pick up your free copy of the complete tutorial at www.teachucomp.com/free.